In today's session, I want you to really lock in and take notes because we're going to break down how to understand market structure, pattern formations, and how to use them to build high-probability trade setups. Now, I know some of you might still be struggling with identifying where price is going, when to enter, or when to stay out, but don't worry. By the end of this session, you'll have a much clearer idea of how to read the market like a story, using nothing more than clean price action. We're going to keep things simple and practical. No complicated indicators, no guesswork, just raw structure and repetition. So whether you're new or already have some experience, this breakdown will help you sharpen your eye, build confidence, and become more consistent in your trading. Let's dive right in. All right, traders, before we dive into the deeper parts of this session, I want to place strong emphasis on pattern formations because they play a major role in our trading as technical traders. So first, let's jog your memory a bit. We've already spoken about the nature of the market, right? Here's a quick recap. The market typically moves in a sequence. It starts with an impulse, followed by a correction, and then usually another impulse in the same direction. This repeating structure is part of a healthy market cycle. Why does this matter? Because the market doesn't move in a straight line. It moves in waves, and understanding those waves helps us stay on the right side of the trade. So let's say the market is clearly bullish. In this case, when we see a clean sequence of impulse, correction, impulse, we continue to look for buying opportunities. That makes sense, right? Now, here's the next important question. How do we know when price is about to reverse? Great question. This is where a trend line becomes very useful. If we draw a trend line above and another one below, just like this, we get a clearer picture of our bullish structure. Now, the key is to observe how price approaches key levels. Let's say price moves up towards resistance, but it does so in a zigzag pattern. This could be a sign of a potential reversal. In this case, we can draw a line below the zigzag to mark the neckline or support. Once price breaks below that line, we get confirmation that a reversal is likely in play. That's our cue to prepare for potential downside movement. On the other hand, if the market is bearish and we're looking for a reversal to the upside, we want to see similar characteristics, patterns that signal exhaustion and a shift in momentum. But if we're expecting the trend to continue to the downside, then we look for this kind of setup. An impulse to the downside, followed by a correction, and then another impulse. That's a classic continuation pattern. And that's it. We keep it that simple. Now, let's take a look at Bitcoin and apply what we've just learned to a real chart example. We're starting on the weekly time frame, and this is intentional because it's always important to begin your analysis from the higher time frames to get a solid understanding of the overall market direction. Higher time frames give us the bigger picture, the macro trend. So, using trend lines, we can clearly see that Bitcoin is in an uptrend. And remember, in an uptrend, we're looking for buying opportunities. We always want to trade with the trend, not against it. Now that we've determined the trend on the weekly, let's scale down to the daily chart to begin our more detailed analysis. We'll start right here at the bottom and work our way up. Notice this. We have an impulse move to the upside, followed by a correction, then another impulse higher. This pattern repeats itself again and again. Impulse, correction, impulse. It's the natural rhythm of the market. Let's go ahead and remove our lines for a moment so we can observe the chart more clearly. Now, even within these corrective moves, there are opportunities to profit. So let's zoom in. These setups aren't always easy to spot at first, but with time and consistent practice, reading them will become second nature. Here's something I personally look for. 3 touches. I look for price to respect a trend line or structure level 3 times. Now, we won't always get those perfect 3 touches, but when we do, it's often a very strong signal. Also, as I always say, price must break something. In this example, we have a clear low right here. That becomes our liquidity point, an area where stop losses are likely sitting. Once price grabs that liquidity, it's very common for it to reverse. Now remember from the course, I called this an area of value. Don't get confused, it's the same thing. So once price reaches that area of value and begins to form a reversal pattern, that's our moment of interest. And right down here, when we start to see rejection signs on the smaller time frames, that gives us our risk entry. The early entry with a slightly higher risk but great reward potential. If price then follows through as expected and breaks above structure, we get a second opportunity, a reduced risk entry. This is where the trade is now more confirmed, and we can enter with greater confidence. Let's keep going and look for more examples so you can see how these patterns repeat and how you can take advantage of them. Alright, so let's say price has been moving sideways, consolidating within a large corrective structure for a while. And now, it finally breaks above. But before the breakout, something important happened. Price first made an impulse move to the upside, followed by a correction, and then another clean impulse upward. So let me repeat this again because it's very important. You must always pay attention to how price approaches your trend line or key level. That structure and momentum tell us a lot. Now as we continue moving up, price forms another big correction. Remember, we're coming from an impulse, so this pullback is part of a healthy trend structure. This is what we call a clean correction. And yes, you can still profit within the correction, as long as you understand what you're looking for and stick to your plan. Of course, nothing is guaranteed in trading. Sometimes price behaves erratically, hits your stop loss, and goes the other way. That's part of the game. Losses happen. What matters most is that we manage our risk properly every single time. Now back to the chart. So price eventually broke out of the correction, right? Let's shift our attention to the current market structure. Price has just come from another impulse, and now we're entering what looks like a corrective phase again. If we draw a trend line across this structure, we can clearly see this is a well-formed correction, clean, with structure and rhythm. Look at this point down here. We have our classic 3 touches at the bottom trend line. That's a key confirmation signal. And remember what I always say, price must break something. In this case, look to the left, we can see a previous high, which acts as our liquidity point. If we drag that level across, you'll notice price tapped into our area of value again, right on time. Now let's scale down to the 4-hour chart to see things more closely. Here's what we have. We can now start planning 2 potential entries. The first entry, our risk entry, would be taken on the 1-hour chart. Let me show you this candle here. This is called a low test candle. That long wick rejection is a clear sign of bullish pressure. Buyers are stepping in and pushing price upward. That gives us a good early signal for a potential move. If price continues as expected and breaks above structure, we'll look for our second entry up at the breakout. This would be our reduced risk entry, because by that point, we have more confirmation that the bulls are in control. But here's the key thing I always remind you. We don't control the market. We don't predict. We react to what price is showing us. Now, one last important reminder. Whether we take the trade or not still depends on how price approaches key levels. For example, let's say price pushes up to that level, but instead of moving strong and clean, it starts forming a zigzag or choppy structure. Something like this. That's a sign of a reversal pattern. In that case, instead of continuing to look for buys, we need to switch our mindset and prepare to look for selling opportunities instead. Always stay flexible. Let the chart guide you, not your emotions. Alright traders, that brings us to the end of this session. I hope you're starting to see how powerful it is to keep things simple. Just understanding structure, pattern formations, and knowing how to react to what price is actually doing, not what you hope it will do. Remember, it's not about being right all the time. It's about having a solid process, managing your risk, and showing up with discipline every day. The market rewards patience, consistency, and clarity. So go back, rewatch this if you need to, mark up your charts, and start training your eyes to see these patterns play out in real time. And as always, trade what you see, not what you feel. Catch you in the next one. Let's keep growing.